We're starting off with a story that's been making waves in the tech industry. SK Hynix, a key supplier of memory chips to companies like Nvidia, has just released its quarterly earnings report, and the results are mixed. While the company's profit rose by 557%, which is certainly an impressive number, it still fell short of investors' expectations. The company reported an operating profit of 60.5 trillion won, which is approximately $42 billion, and revenue came in at 79.3 trillion won. However, these numbers were lower than what analysts had predicted, with the average estimate being around 64.2 trillion won for operating profit and 83.9 trillion won for revenue. One of the main reasons for this discrepancy is the growing concern that the AI boom, which has been driving demand for memory chips, may be slowing down. This has led to a decrease in the company's stock price, with SK Hynix losing over $500 billion in value since June. It's worth noting that the company's net income did surge by 1,242% due to one-time investment gains, but this hasn't been enough to alleviate investors' concerns about the future of the AI industry. With tech companies taking on more debt and the potential for a broader economic slowdown, investors are becoming increasingly cautious. We'll be keeping a close eye on how this story develops and what it means for the wider tech industry. Will SK Hynix be able to bounce back from this setback, or is this a sign of things to come? We'll be exploring these questions and more in upcoming episodes. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a crucial topic that affects us all, the environment. A recent study has shed light on India's planned national carbon market, which is set to begin trading in carbon credits by October. The goal is to reduce emissions from major sectors such as steel and cement production. However, the study suggests that the penalties for polluting may be too weak, with expected low allowance prices of around $10 per ton of carbon dioxide equivalent. This raises concerns that the market may not provide a strong enough incentive for companies to curb their emissions. In fact, the cost of purchasing credits to cover emission shortfalls would only equate to a small percentage of annual profit for many industries, making it more economical for them to continue polluting rather than adopting low-carbon processes. It's essential to consider the implications of this market on India's overall emission reduction goals. As the world's third-largest source of greenhouse gases, India has a significant role to play in global efforts to combat climate change. While the country has set targets to reduce its emissions intensity, the absence of absolute limits on emissions and the exclusion of the power sector from the initial stages of the carbon market may limit its effectiveness. As we weigh the pros and cons of this approach, it's crucial to remember that a balanced strategy is needed to address the complex issues surrounding climate change. On one hand, economic growth and development are vital for India's progress, but on the other hand, the environmental consequences of unchecked pollution cannot be ignored. The Indian government must carefully consider these factors as it moves forward with its carbon market plans. By striking a balance between economic growth and environmental sustainability, India can create a more effective and equitable system that benefits both its economy and the planet. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to shed light on a critical issue that affects us all, whether we're investors or simply concerned citizens. The Amazon rainforest, often referred to as the lungs of our planet, is facing yet another threat, this time from gold mining. The rising value of gold has led to an increase in illegal gold mining activities in the Amazon, resulting in devastating environmental and social consequences. Deforestation, water pollution, and even violent crimes are just a few of the many problems associated with this practice. But what is often overlooked is the role that financial institutions and investors play in perpetuating these activities. Central banks, in particular, have a significant influence on the gold market, and their purchasing decisions can inadvertently fuel illegal mining operations. By not demanding transparency and accountability from their suppliers, they may be unknowingly contributing to the destruction of the Amazon. It's essential to acknowledge that this is a complex issue, and there are no easy solutions. However, by promoting greater transparency and due diligence in the gold supply chain, we can start to address these problems. Investors and financial institutions must take responsibility for their actions and ensure that their investments are not harming the environment or supporting illicit activities. The connection between the world's vaults and the Amazon's rivers may seem indirect, but it's real. As investors, we have a choice. We can either contribute to the problem or be part of the solution. By making informed decisions and demanding more from our financial institutions, we can help mitigate the risks associated with gold mining and protect the Amazon for future generations. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.